we're going to talk for a minute about real estate professional status, sometimes abbreviated REPS, REPS. Now, what real estate professional status is probably not the most important thing about it. The most important thing about it is that when you combine it with a high income profession, typically medicine when we're talking about it around here, and it doesn't have to be you that has real estate professional status, it can be your spouse. But when you combine it with a high income profession, you can take the depreciation from the properties that you are buying and use that tax deduction against your active earned income as a doc or whatever else you do. And that's a very powerful tax technique, right? Most docs are in a pretty high tax bracket. Maybe they're paying, 32, 35, 37% with state tax, maybe it's pushing 50%. So a big, huge deduction like you might get when you purchase a new property, whether you're doing it, typically you're doing it actively. So you're buying a new property and maybe you're getting, a little extra bonus depreciation. And you can use a lot of that against your earned income. It becomes very powerful. Now, all of a sudden, all that money you were paying in taxes, you can use to build wealth. So it's pretty cool. At any rate, to qualify for this, you have to spend 750 hours on real estate, right? And it's doing real estate, right? It's not just, learning about real estate. You got to be developing, you got to be redeveloping, you got to be constructing or reconstructing, acquiring, converting, renting, operating, managing, leasing, functioning as a broker, okay? It's not the stuff that you often think about when you think about what a real estate investor does. It's not education. It's not searching for new properties. It's not studying financial statements. It's not managing the finances of an activity in a non-managerial capacity. It's not commuting to your properties. It's actually doing real estate. So if you or your spouse is doing that for 750 hours at a minimum a year, you can qualify as a real estate professional. And you can take that depreciation deduction, which is normally only be able to be used against passive income, and use it against your active income. There's another rule, though. It's got to be greater than half of your professional time. So if you're doing 750 hours in real estate and you're doing 1,000 hours in medicine, no dice. You are not a real estate professional. So you can do 500 hours in medicine and 750 hours in real estate and qualify, but not the opposite. And you also have to materially participate in the property, right? So that's got all kinds of other regulations about it. But if you're interested in direct real estate investing, and particularly if you have a spouse that is willing to dedicate a significant amount of time, because 750 hours is a significant amount of time. That averages out to 17 hours a week. This is a part-time job. If your spouse is interested in a part-time job in real estate, this can be really powerful when combined with your physician income. There is a little bit lower barrier to get this, and that's what they call the short-term rental loophole. Instead of 750 hours, you may only have to put in 100 hours, and that's a lot easier to get. That only averages out to a couple of hours a week, and it doesn't take very many short-term rentals to suck you in for a couple of hours a week if you're doing the management yourself. And so that's a little bit easier, threshold to get over, and you really only have to do that for the first year, right? So if you don't want to have a long-term, short-term rental, well, that's a weird way to say it. If you don't want to have a short-term rental indefinitely, you don't have to, but you just have to for that first year to take advantage of that loophole. So you can acquire properties building a long-term rental portfolio as long as you make them short-term rentals for the first year or so, then it works out. Hope that's helpful and can help some of you out there who are interested in a significant side gig of doing direct real estate investing. Obviously, as I think this interview with Frankie demonstrated, this can be very profitable. It certainly is a viable pathway to wealth. It takes a lot more work, effort, and education than just carving out a big chunk of your income and plopping it into a static asset allocation of broadly diversified low-cost index funds. But there are some rewards there too, particularly if the risk you take, like Frankie did with all that leverage, pays off.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.